Hello, my name is Charlie Moran. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Sharif Abdu and Alan House. We at Value Line hope you and your family are staying safe and dealing with this difficult time as best as possible. Today we're going to provide an update on the coronavirus and its ongoing impact on the economy and stock market. We will also discuss the actions Value Line is taking to help our subscribers navigate this difficult time. We will then recommend one stock to buy right now and finally answer any questions you may have. Please note that this presentation will be available on our website, valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service is published weekly and created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including the 1,700 that are included in this service. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. Now, let's discuss the coronavirus, the economy, and the stock market. This content was prepared by Harvey Katz, Value Line's chief economist. It has been a most unsettling year for the U.S. economy. To be sure, things started out routinely enough with continued steady, albeit modest, business growth during the first 2 months of this year. Then the upturn suddenly unraveled. The reason for this reversal was the spread of the COVID-19 virus, first across Asia and the southern tier of Europe, and then into the New World. The economic toll of this deadly pandemic also has been severe, as GDP fell 5% in the first quarter and then plunged by a historic 32.9% during the second 3 months. Millions of Americans have lost their jobs. Businesses have closed at an alarming rate. The balance sheets of untold Americans have deteriorated, and the Federal Reserve and the U.S. government have taken extraordinary monetary and fiscal steps to prevent an even greater economic catastrophe. Such actions have helped the nation to weather the storms to a certain degree. Now, as the third quarter winds down, the strides made during the spring seem to be largely staying in place in spite of the continuing heavy toll from the coronavirus. For example, the Institute for Supply Management reported gains in manufacturing activity and the services sector in July. Retail spending and industrial production also rebounded after historic declines, but consumer sentiment has flattened as Americans have turned cautious in their outlook. Also, new weekly jobless filings and continuing claims, which track longer-term joblessness, have stayed stubbornly high, though there has been some decline in recent weeks. Adding it up, we sense that GDP, which fell moderately during the first quarter before tumbling in the second 3 months, will return to a growth track this quarter, with the upturn continuing, albeit with less flair down the home stretch of 2020. As for the stock market, it has been an up and down affair this year. As with the economy, things started out on the right foot with a lengthened string of higher highs as the Dow Jones Industrial Average made its way to the doorstep of 30,000. Then COVID-19 made its presence, and the economy, earnings, and stocks all swooned. The market's collapse would be brief but unnerving, with the Dow tumbling from 29,568 to 18,213 in a few short weeks. Importantly, as the stock market often leads the economy, equities have recovered well before the nation's business has, and certainly ahead of corporate earnings. In fact, we are now near the historic market highs of early this year, with the S&P 500 index and the NASDAQ already reaching all-time peaks. The main reason for this strength, we sense, is a highly supportive Fed. Moreover, hopes for a vaccine, expectations the economy will continue on the mend, and projections of a comeback in earnings are also contributing to this renewed run by the bulls, which shows no signs of letting up as August ends. In conclusion, we believe holding a diverse set of quality stocks remains a sound investment strategy. As stated earlier, the economic situation remains difficult, and it's going to take a while to recover. Many in the medical community also assume that a second wave of COVID cases could hit this fall or winter, which would, of course, significantly hamper a recovery as well as introduce new problems. While I don't think that the stock market will retest near the lows from February and March, I would not be surprised to see some backtracking, and even if the major indexes do advance from here, it probably won't be in a straight line. Thus, we recommend that investors tread carefully and prepare for a bumpy ride. On that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's valueline.com. I will now show you how to access it. Once signed in, head to the dashboard where I'm already located. Here we are. I wanted to make sure that the supplementary reports could be seen and that one can see the Value Line dashboard and the screen that we will be going to as we look for the stock to purchase. Again, the supplementary reports, once one is to click on that, you can see the what the research department has been busy publishing on updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. We are also aggressively adjusting our financial strength grades. Individual companies are dealing with sharply reduced demand for their offerings and supply chain problems. Among other issues, consequently, corporations have been implementing cash-saving initiatives such as headcount cuts, the slashing of advertising budgets, and reducing or eliminating their dividends. Taking on additional debt has also been popular as a means to build cash in anticipation of difficult times ahead. Due to the rapidly deteriorating balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our selection and opinion newsletter, and since there were so many changes recently, we have emailed out the list to our subscribers each Monday. For those of you that don't know, financial strength along with price stability, another proprietary value line measure, are the two metrics that are used to calculate a stock safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Certainly particular industries and sectors will recover more quickly than others during and after this pandemic runs its course. Okay, intro to the screener. Now let's move on to the one stock to buy right now. For this, let's go to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE LINE. Since I earlier preached caution, I am going to create a screen that only focuses on the most stable and successful issues. There are loads of risk measures out there and several that Value Line offers, and I'm going to start with our time-tested safety ranks. So we will go to the screener up here in green on the Value Line page. And that will bring us to the stock screener. On the left, you can see a variety of criteria. And if you scroll down beneath income statement projections, valuation ratios, and ranks and ratings, you'll see safety rank. The safety rank measures the total risk of a stock, and it's arranged on an easy-to-understand scale of 1 to 5, with 1 being the most conservative of issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. At the same time, they also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. So, as I mentioned before, on the left-hand side, you see the ranks and ratings section in gray. I'm only going to focus on those stocks ranked 1, highest for safety. These are the largest, most stable equities under our coverage universe. So, as you move the scroll over there and press on the safety rank icon, you will see the safety ranks appear up above, and you go to 1, and you will find that the matches presented from the 1,700 stock universe in Value Line, the 5,700 or so stocks in our database. As you can see, only 123 garner this top rank. Now, as we apply other filters, we will add an additional level of security. As mentioned earlier, loads of companies are reducing headcount, taking on more debt, and eliminating their dividends. Thus, balance sheets have greatly weakened. Although it is already a factor in the calculation for safety, I am going to double down and include a measure called financial strength, which I am selecting right now. And we go back to see the filter. These grades range from C to A++ in 9 increments, as you can see. I am only going with the A++ here. I want the strongest of companies, and by selecting A++, we further narrow our search down to 56 matches. Okay, now let's narrow down that list a little further by looking at price potential in the year ahead. For that, I'm going to include timeliness, which is a proprietary value line measure evaluating a stock's projected price performance in the coming 6 to 12 months. It's a straightforward scale from 1 to 5, with 1 being the highest. I want to focus on that based on our projections have the most promise in the near term, so I'll set the screen to stocks ranked 1. And as I do so, selecting the timeliness rank stocks of 1, our highest rank, the filter is now down to 10 prospects that you can see below. Now we can whittle the list down even further, and for that I'm going to focus on the dividend yield for the pool of stocks that we have so far. I'm going to select the dividend yield again on the left. It's in a different section beneath valuation ratios, and I select that filter and go above 2.4, which I am using as the minimum yield, and I apply the filter as so on the right, and we have narrowed down our selected range to just 4 matches. Finally, we will choose a screen for 18-month price performance. That is above under company data, and by selecting 18-month TPR midpoint, we have selected above 20% for the coming 18 months as a minimum, and the filter, after being applied, brings us to 3 stocks. As you can see, these are all large, well-capitalized companies with long track records of steady increases to the payout. You can certainly make an argument for any of our remaining stocks, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of my senior analysts, we prefer to recommend Lockheed Martin, ticker symbol LMT. Before I go into specifics, please note that screens can be saved and revisited by utilizing the button at the top. Now, let's click on LMT and get some additional information from Value Line's digital report. I'm going to bring up the most recent page. Well, I'll comment now on LMT before we get there. LMT shares have been a consistent performer thanks mostly to the F-35 program, which has been a mainstay in the Defense Department. This program now accounts for roughly 1/3 of the company's sales, and we think its importance to the government provides a measure of support to the stock in a period of overall economic uncertainty. Second quarter sales, announced a month ago, increased 12% year over year, and earnings per share were up 16%. Respectively. Management stated that backlog reached a record $150 billion. Other programs, including the F-16 and entry into space platforms, should boost earnings in the upcoming year. We currently see earnings rising by a mid-single-digit percentage in 2021. Financial metrics are all solid. Safety rank is 1, the timeliness rank is 1, and the financial strength is A++. As mentioned previously, the dividend is approximately 2.4%, extremely secure, well covered, and the 18-month target price is appealing as well. Now let's see if we can bring up the full page report. Here we go. It's coming up now, the June 5th report. Here is the value line page for Lockheed Martin. This was last published in June. As you can see in the statistical array, or the center of the report, that includes the financial data, Lockheed appears poised to post stable annual increases in revenues, profits, and book value, among other measures. We look for the company to record consistent results this year, which is a good showing given the recent state of the economy. The defense industry is often considered relatively immune to economic conditions, and Lockheed's profile is also more stable than that of defensive rivals. All told, we think that Lockheed's position is quite strong, and the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. I will now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few were submitted prior to this presentation.
Thank you very much, Charlie. That was a great presentation. This is Alan House, Senior Analyst at Value Line. There was a lot of good questions here. The one that I first saw, are the safety ranks evenly distributed throughout the Value Line universe? And that's an excellent question, particularly since Charlie said that Lockheed Martin garners our #1 safety ranking. And as you can see by the screen, there wasn't that many stocks that had that high of a rating. So to answer that question, no, it's not evenly distributed. It's more like a bell-shaped curve. There's more stocks that are ranked 3, and then a few less that are ranked 2 and 4, and then even fewer that are ranked either 1 and 5. So it follows pretty much a bell distribution. So I just would like to answer that question first. So yes, Lockheed Martin is one of the relative few stocks that garners our highest safety rank. Thank you.
Hi, thanks, Alan. My name is Sharif Abdu, also a senior analyst here at Value Line. So we have another question that looks pretty interesting. Do you update the stock reports always after the company has released their quarterly results? So with the Value Line Investment Survey, we publish our full-page reports on a regular quarterly cycle. So for example, we publish one report per stock every 3 months, and that's on a set schedule. Now, more often than not, our publishing cycle falls in line with the stocks under our coverage. So, for instance, Apple will report its quarterly results, and Value Line will publish a full-page report shortly after, and that full-page report will incorporate whatever Apple had reported in that latest release. However, in some cases, those cycles are not aligned. So, for example, let's say IBM reports quarterly results, but the most recent Value Line full-page report that was published went to press a few weeks earlier, okay? So that report obviously would not incorporate IBM's most recent results. So in those cases where our cycles are not aligned, it's Value Line convention to publish a supplementary report, which Charles touched on earlier. We do that if there is what we would call like price-moving information in a company's quarterly release. So, for example, it's an earnings surprise. Earnings are much better than expected. Earnings much weaker than expected. There's an unexpected dividend increase or dividend cut. Something that we would consider market moving. So it's also worth noting that Value Line publishes supplementary reports for all Dow 30 stocks, regardless of the timing of our cycles. All Dow 30 stocks automatically get a supplementary report in addition to our regular full-page reports. Okay, I'm going to hand it back off to Alan. Alan, if you're ready, if there's a question that's jumping out at you.
Sure. Thank you very much, Sharif. The next question I saw is the timeliness ranking system based on price and earnings momentum? And that's also another great question. As you can see, as Charlie noted, Lockheed Martin is also ranked #1 for timeliness. And to answer that question, it's yes and no. There's many factors that go into our proprietary ranking system. Price and earnings momentum is are two of the factors, but there are many other factors that are involved in our ranking system. So yes, it does play a factor. It's one of the many factors we look at with a stock when we assess the ranking system. So I just wanted to address that question. Thank you.
Okay, let's see. Is there another question that jumps out at me? Okay, we have an interesting one here. Given the current economic climate, what are your thoughts on the REIT sector in general? Is there a particular REIT that you think is being undervalued? That's a hornet's nest. Let's see. I'll say this. In general, Value Line, we don't like to make blanket statements, but we would exercise some caution with regard to the REIT sector as a whole. Certainly, there are lots of well-capitalized companies in the industry, and our long-term view of the industry is very favorable. But given the current climate, it is trying to evaluate the overall health of the commercial real estate market. I mean, it's never been more challenging. So just to summarize, I would say if you're looking for undervalued stocks, we don't think the REIT sector would be our first choice. If you have REIT holdings, I think you're fine. But I think if you're looking for undervalued stocks, like I said, excuse me, we don't think that the REIT sector would be our top choice. That's not where we would set our sights. Let's put it that way. Alan, anything else that you want to answer? Any good questions there?
Yeah, I saw another one that just came up by Lewis. I'm sorry. What did TPR stand for? And yes, that was a very good question. TPR stands for target price range, and we actually have two target price ranges now on our Value Line page. We have a 3 to 5 year target price range, which targets the 2023 to 2025 time frame. And we also just initiated, I believe it was earlier this year, or possibly late last year. It was definitely within the last 12 months. We instituted the 18-month target price range. And, our ranking system is based, largely on the outlook for the next 6 to 12 months. And we've always had the 3 to 5 year target price range. And we thought it would be a good idea for investors that are with a more intermediate term outlook to have an 18-month target price range. So as Charlie alluded to, Lockheed Martin also has good appreciation potential based on our target price range over the 18 months ahead. So I hope that answers that question. Thank you.
Okay, I see one very good but very tough question here. I see the question is, with banking stocks, are there any specific measures to look at as indicators that the worst may be over for that industry? So anybody that has tried to read the financial statements of any banking stock, it's basically alphabet soup, a lot of ratios and metrics, and a lot of good stuff in there. There are a number of metrics that you could look at here. You could look at like the net interest margin, net charge-offs, efficiency ratio, many more. But if we're going to look at one indicator that we would consider a leading indicator regarding the health of the banking industry, it would probably be the provision for loan losses. So what is that measure? The provision for loan losses are funds that the company has set aside in anticipation of future losses. Why we think this is a very good leading indicator is because this is management's view of what the company's near-term prospects are going to be, right? So if they think that loan losses are going to be elevated, you'll see that the provision for loan losses will suddenly rise. For example, I believe J.P. Morgan, just one company off the top of my head, their provision for loan losses projected for this year is in excess of $20 billion. So just to put that in perspective, that provision last year, I believe, was in the $5 to $6 billion range. So obviously it's grown exponentially because management is anticipating that loan losses are going to be substantial this year. You know, it's going to be kind of an outlier year. Next year also probably going to be a little bit elevated, not as bad as this year. But so it gives you sort of a view of what the company insiders, what management thinks that the company situation is. So that's one number we would look at, the provision for loan losses. Alan, is there anything else that's jumping out at you?
Yes, I saw one more question that caught my eye. It was a question related to the difference between the timeliness and the technical rankings, and that's actually a very good question. You know, the two are in many ways mutually exclusive. A stock can have a high timeliness rank and a somewhat low technical rank. The technical rank differs from the timeliness rank in that it's more of a technical, quantitative approach to rating the stock. Whereas though the timeliness rank does have some, you know, quantitative factors in it, there are also some fundamental factors that weigh in. So that's, you know, the way I look at it as the timeliness rank also incorporates fundamental factors, where the technical rank for by and large is only the quantitative factors. So that was another excellent question. Thank you.
Thanks, Alan. I'm not seeing anything else that's jumping out at me at this moment. Is there anything else that you see that you'd like to address? Alan, Charlie?
Not at the moment. I don't see anything that jumps out at me at the moment. Thank you.